great. It's great to be on the show. So I think it's pretty well understood by now that gold moves inversely to real yields, and it's not a surprise that gold's making new record highs at the same time as real yields is making new record lows. But I think that just kind of begs the question: what's driving real yields lower? And if you take a look and break it down, since about June, that entire decline in real yields have come from rising inflation expectations, even as nominal yields haven't really moved. And that divergence I would attribute to the Fed and the effectiveness of the Fed at forward guidance, right? Pledging to keep rates at zero, even if inflation overshoots. And against this backdrop, I think what's interesting is gold is moving higher because of rising inflation expectations. It's become just another reflation trade, very similar to equities, and you see it in the correlation between gold and equities. This is something I want to point out because I think traditionally gold is known as a safe haven defensive asset. And that's been true for many years, right? If you look at the correlation between equities and gold, that's been persistently negative in recent years. However, in recent months, that has turned positive. So now gold is moving more in tandem with equities, behaving more like a risk asset. And it's not unprecedented, right? The last time we've seen persistent positive correlation between gold and equities was in the aftermath of the last crisis, right? Not coincidentally, another time where, Fed cut rates to zero and we had massive amounts of stimulus coming into the system. So to me, it's really important to break down what is driving gold. And right now it's reflation.
So, Mandy, this is really important because, as you've noticed, rate vol has totally collapsed because of this shift in the Fed's reaction function. And many people are thinking about pivoting away from treasuries to gold. And as you've pointed out, if there's a positive correlation between gold and equities, you're not getting that inverse correlation if you go from treasuries to gold. What do you say to clients about that issue right now?
Exactly. I think in this environment with rate vol at basically zero and with yields where they are, a lot of investors are looking for an alternative for a hedge for their multi-asset portfolio, right? Because bonds are just not as effective of a hedge for their equity risk. And a lot of people have turned to gold because of this traditional negative correlation. And that's why I'm highlighting to them this shift in correlation regime means gold may not be as a reliable hedge for your equity risk. And instead, you should be more looking at equity-specific hedges rather than relying on this correlation regime that may or may not hold up.
What are the equity-specific hedges you recommend then, Mandy?
So I think right now what we're seeing actually on the hedging front is a complete capitulation on the part of hedgers. I think a lot of people have thrown in the towel with the sharp rally that we've seen. And one way you can see that is in the steepness of the S&P vol curve. So that's something that really stands out on the equity front is the difference between, say, S&P 3-month vol and 1-month vol right now is at a record. And it's at a record not because of how expensive 3-month vol is, as you would think with the election. Actually, that's trading in line with global peers. It's really at a record because of how low 1-month vol is. There's just been a complete lack of near-term tactical hedges. And to me, that's a mistake given the number of actual U.S.-specific catalysts that we have coming up. I would point to the ongoing talk in Congress as probably the #1 risk to watch out for. I think the investor consensus is still that we'll get a deal, right? Something will get done. But to me, the risk of a protracted no deal is rising every day. And that's something that people are not prepared for. So we like looking at tactical near-term hedges in the S&P, given how cheap the level of vol is and the steepness of the curve.
Mandy, I had this conversation with Kathy Jones at the top of the programme. Are you sensing the same thing, the complaints about complacency all over again? And how much of it a pain trade is it to try and push the other way?
I think the pain trade in equities is actually not, the direction of the market, but it's actually the value versus growth rotation, right? So I think that's why I think last time I was on the program, I talked about we're seeing that bid to vol and NASDAQ going into tech earnings is because a lot of people have basically crowded into the tech position. I think the pain trade in equities is a sell-off that is led by tech rather than a sell-off that is led by value because of how over-owned and concentrated the holding is in tech. But that, to me, is the pain trade in equities, not really where the S&P goes, but where NASDAQ goes.